Gold has been volatile. Some days it's screaming higher, other days it's pulling back hard. And if you're holding it, or thinking about holding it, you're likely asking yourself one simple question. Is this a crash I should fear, or an opportunity I should be buying? Here's what's maddening about this moment. The financial media is giving you contradictory answers. Mainstream analysts are calling gold a bubble. Tech influencers are dismissing it as a relic. But simultaneously, central banks around the world are buying gold at levels we haven't seen in decades. Warren Buffett just loaded up on gold, and the wealthiest families are quietly moving serious money into precious metals. So who's right? And more importantly, what do you need to know before you make your next move? By the end of this video, you'll understand the real mechanism driving gold's price action right now, and you'll see why the next 12 to 24 months could be absolutely critical for your portfolio. Let's start with what you're seeing right now. Gold has pulled back from all-time highs. The last few months have delivered some painful drawdowns for gold bulls. And that's created this psychological breaking point where retail investors are asking, did I miss it? Is it over? Meanwhile, the US dollar has been surprisingly strong. Interest rates have stayed sticky and higher for longer than many expected. And if you believe those two things, the logic seems simple. Higher rates and a strong dollar are bad for gold. But here's what most people miss. They're looking at the surface. They're looking at the immediate price action and the last quarter's headlines. But they're completely ignoring the structural forces that have been building underneath for years. The real mechanism is far more complex. And once you understand it, you'll see why this pullback might actually be one of the most dangerous moments to be sitting on the sidelines. Let me break this down into stages. Stage 1 is what we're living through right now. The dollar is strong because the Federal Reserve kept rates higher than expected. The Fed needed to fight inflation, so they raised rates aggressively, and that attracted foreign capital into US dollar assets because the returns looked attractive. When you can get 5, 6, maybe even 5.5% returns on a US Treasury, suddenly gold, which pays no yield, looks less appealing. That's basic opportunity cost. And retail investors felt that pressure immediately. Stage 2 is where most people get confused. They assume that higher rates are permanently supportive for the dollar. They assume the Fed can hold rates here indefinitely. They assume we're back to normal. But that's only the surface explanation. The real story is that America's debt situation has become unmanageable. The US government is now spending more on interest payments alone than it spends on defense. Think about that for a second. The debt is so large and rates are so much higher that just servicing that debt is consuming a historically gigantic portion of the federal budget. And here's the kicker. We're not even in a recession yet. We're not even in an actual crisis. We're in a relatively normal economic environment, and we're already at a point where debt service is eating the entire budget alive. So what happens when we get a real recession? What happens when unemployment spikes, tax revenue drops, and the government is forced to spend more on social programs while collecting less in taxes? The math breaks. History shows this pattern again and again. Look at 2008. The Federal Reserve was forced to drop rates to zero and buy assets because the system couldn't handle higher rates. They had to flood the system with money. Look at 2020. The same thing happened. Rates went to zero. The Fed balance sheet exploded. Look at Japan. Japan pushed rates to zero in the 1990s, and they've been there ever since. Because Japan's debt is so large that normal rates would break their budget. And America is following the same path. But that's only the surface explanation. Here's where everything changes. For decades, the dollar's strength came from one simple fact. There was no real alternative. If you were a foreign central bank, a pension fund, or a sovereign wealth fund, where else were you going to put your money? The dollar was the world's reserve currency. Treasuries were the safest asset. The US had the world's largest economy. But that's cracking. China and Russia have been deliberately moving away from dollar-denominated assets. They've been signing bilateral trade agreements that bypass the dollar entirely. The BRICS nations have been discussing alternative reserve currencies. Saudi Arabia has been accepting Chinese yuan for oil, not just dollars. And it's not just geopolitical posturing. Every time America sanctions a country or freezes assets, it sends a signal to the rest of the world. Holding dollars is a risk. That's why central banks globally have gone on the biggest gold buying spree since the Bretton Woods system collapsed. They're diversifying away from dollars because they're starting to price in the risk that the dollar's reserve currency status might not be permanent. This is the structural shift nobody's talking about clearly enough. So now we have a situation where we're in stage 2. Rates are high, the dollar looks strong, gold is being punished, but the underlying foundations are shifting. Stage 3 is what comes next. And this is where the opportunity gets real. Eventually, and we're talking about the next 12 to 36 months, the debt crisis becomes impossible to ignore. It might be triggered by a recession. It might be triggered by a geopolitical shock. It might be triggered by a banking crisis. But something gives. When it does, the Fed will be forced to cut rates aggressively. They'll be forced to print money. They'll be forced to monetize the debt because the alternative is letting the system break. And when that happens, all the money the Fed prints has to go somewhere. It flows into real assets, stocks, real estate, commodities, and gold will be at the top of that list. Why? Because gold is the ultimate insurance policy against currency debasement. When central banks start printing, when confidence in fiat currencies starts to crack, people run toward gold. Now here's why this time feels different. Throughout the 2010s, many people predicted this exact scenario. They were right about the debt. They were right about the eventual need for money printing. But they were early. The Fed managed to contain the problem longer than expected. They did quantitative easing. They did yield curve control. They extended the runway. But the debt kept growing. And now we're at a point where the math is undeniable. Federal government spending is exceeding revenue by historic margins. The debt to GDP ratio is approaching 130%. The interest on the debt is growing exponentially, and there's no credible plan to address any of it. Meanwhile, geopolitical tensions are the highest they've been since the Cold War. We have actual wars in Ukraine and the Middle East. We have trade tensions with China. We have sanctions regimes that are accelerating the de-dollarization trend. And we have a structural shortage developing in physical silver, the industrial metal that's closely related to gold's monetary premium. All of these pieces are in place. So what happens next? I see 3 possible phases. Phase 1 is where we might be right now. Gold consolidates or pulls back slightly as rates stay sticky. The dollar remains resilient. But underneath, central banks keep buying. Institutional money starts positioning. The smart money is already preparing. Phase 2 is the trigger event. It could be a recession that's worse than expected. It could be a banking crisis sparked by commercial real estate stress. It could be a geopolitical shock that forces a major shift in trade flows. Something breaks the current equilibrium. Phase 3 is the repricing. When the trigger event hits, central banks will be forced to cut rates rapidly. The Fed will restart quantitative easing. And suddenly, all the dollars sitting in bonds will flow into hard assets, including precious metals. During Phase 3, gold could move significantly higher. We're not talking about a slow grind. We're talking about the kind of repricing event that catches most retail investors off guard. Now, what should you be watching? Signal number 1, the Fed's language. If you start hearing the Fed pivot toward rate cuts, if they start talking about easing, that's your early warning. The institutions will move first, but the media coverage will tell you when the shift is happening. Signal number 2, central bank gold buying. Track the monthly reports from the IMF and major central banks. If gold buying accelerates from current levels, that's a signal that the world's largest money managers are getting nervous. Signal number 3, the dollar index. If the dollar starts to weaken despite higher rates, that's a sign that faith in the currency is cracking. That would be the most powerful catalyst for gold. Signal number 4, real yields. Watch the yield on Treasury inflation-protected securities, or TIPS. If real yields go negative, it means investors are literally paying the government for the privilege of holding their debt. When that happens, the value proposition for gold becomes irresistible. Here's the hard truth. We are living in a delayed debt crisis. The crisis hasn't arrived yet because central banks have been willing to suppress rates and print money. But that suppression has a cost. It creates inflation. It creates misallocation of capital. It creates bubbles in certain assets while starving other sectors. Eventually, the suppression becomes more painful than the crisis would have been in the first place. And that's when everything reprices. Gold isn't crashing, it's consolidating, it's coiling. It's waiting for the moment when central banks are forced to abandon the fiction that they can keep rates high and debt manageable simultaneously. When that moment comes, and it will come, Gold will move in ways that most people aren't prepared for. The investors who are buying into this pullback, who are accumulating gold while it's still in a range, who are positioned before the trigger event, those are the investors who will look brilliant in hindsight. But the investors who are waiting for absolute confirmation, who are waiting for gold to break to new all-time highs before they buy, those investors will be buying at much higher prices. The window for buying gold before the repricing event is probably measured in months, not years. We're not talking about a crash. We're talking about an opportunity that feels wrong in the moment, but will feel inevitable in retrospect. Because here's the thing about macro cycles. They're not dramatic every day. They're quiet, boring, and confusing 95% of the time. And then, in the span of weeks, everything changes. We're in the quiet part right now. The drama is coming. If you want more deep market analysis like this, where we look under the surface and show you the patterns that mainstream media misses, subscribe to this channel. Turn on notifications and stay close as we navigate what might be the most critical period for precious metals in a generation. The gold opportunity is in front of you right now. The only question is whether you'll see it before everyone else does.